Let's talk to Mike van Dulken. He is the head of research at Accendo Markets. Morning to you, young Mike.
Good morning.
Right, 3 thought-provoking slides. Let's kick off without further ado. Let's kick off with Carnival PLC. What are you thinking?
Well, halfway through the bounce, you'd like to think that the bounce continues.
Yep.
I think the fact we've bounced a fair way from the lows, and I think you can probably put intersecting support in there around 46.50 in case you're worried about a full-on pullback. But for the moment, especially with oil prices off the boil and the potential for, might even be tonight, Russia and OPEC or Saudi Arabia to decide that they might put a timetable to ending their production cuts.
Yep.
That could bring the oil price lower, which is great for a company like Carnival because it's meant higher fuel costs or having to work hard to hedge those higher fuel costs. So I think that's in line with the recent rebound. So if the oil does keep coming off the boil, then I think potential for that to keep rallying back to the highs. Whether it breaks out is another matter entirely. For the moment, we're looking at a potential trade there within that narrowing channel.
Understood. Well, I actually have done a couple of cruises historically,
Okay.
and I think they're very, very good value. So fundamentally, maybe that's agreeing with the technicals. Okay, let's move on to Berkeley Group. That's a magnificent uptrend, obviously trying to turn over. This is where I used to sort of try and pick tops, and we know what happens with top pickers.
Oh, yeah.
What are your thoughts?
Well, I mean, we were especially interested in, as you say, that strong uptrend and the very neat trend line below the rising lows. It then faked out above the prior record highs, which were back in early January there, around 42.60 or thereabouts. And then the pullback was quite sharp. You see that long lower candle that brought us back.
Yeah.
And then we held up for a day or two. But for me, the move is this morning's to break below all the support that goes back to mid-May in one go. Kind of confirms with all of those reasoning together a reversal, a breakdown, and a potential for a retreat. How far the retreat goes, I mean, potentially all the way back to those lows. UK housing market is slowing.
Yep.
We've had Chris Nicholson come out the other day talking about being squeezed on input costs. That either my example a few weeks ago is actually Ibstock. They make bricks and tiles. They were saying, look, we're having to push through price rises and we're going to put through more. I said, well, either you're going to get away with it or you're going to struggle. If you get away with it, the house builders are going to have to take it on the chin. And Chris Nicholson, the first really to highlight that. And the risk is that with house prices falling, that the margins for the house builders are going to be further squeezed. So they've had a remarkably good run of it, in line pretty much with a very solid UK housing market. But is that turning? There's uncertainty out there. Rates potentially rising in the next 6 to 12 months. It's more consumer confidence is being slightly dented. Or even if retail sales, which has just come out now, are better than expected, that's only really a rebound from the tough March and everything grinding to a halt. But it may have also been flattered by the royal wedding and the warm weather. So there's conflicting signals out there. But I think overall, the UK housing market on multiple levels looks to be the price growth looks to be slowing. It's not necessarily falling everywhere, but it's definitely slowing. So is the run for these guys are the days numbered, if you like.
Understood. Okay, let's wrap up with Hargreaves Lansdown. Record highs, extraordinary bullish charts.
I mean, that's only showing 6 months worth. I mean, I've had to zoom in, so it's nice and clear. If you zoom out over several years, it's even more impressive. But what's very interesting for me here is the fact that in May we broke above January's record highs.
Yeah.
Then we pulled back in May.
Yeah.
And it pretty much held up that breakout as support, so what we call resistance turned support.
Yep.
Then we've gone on to rise higher, above the new record highs, and it's not the most perfect bullish flag, but the overall idea is there: a sharp run up, a pullback to consolidate, and then a break higher that looks to have potential to mimic the initial uptrend. Which would just take it to further record highs. I mean, projecting that, you're looking at 17.20 to 20, so £2.80 from £18 or so. You could be on for 21, 22 pounds.
And do the fundamentals at the moment support the price? Obviously, there's lots of arguments about passive investing and the
Yes.
charges, etc., etc.
Yeah, but there's also, more people interested in DIY investing, doing it themselves, taking money out of their pensions, putting it into SIPs or cashing out and doing their own thing. I think the results from the asset managers over the last little while have shown them benefiting markedly from the volatile during the first quarter. There perhaps hasn't been quite as much in Q2, but I think overall markets are still very close to record highs. The FTSE's within spitting distance,
Yep.
the Nasdaq's at highs. The US it looks as if it's itching to be there. Tech is still doing strong. People are still wanting to be in the markets. As you said earlier on, picking the top is a difficult one. I think picking the top in global markets right now would be a very difficult one. So for the moment, I think the overall fundamentals for these guys is still strong across the asset management sector, to be honest.
On that note, young Mike, we're running out of time. Thank you very much indeed.
Thank you.